This is my 1-minute strategy that has been proven to make $11,870 a month. This is a high win rate strategy that has been perfected over time. I'm not just going to show you step by step how to use this strategy, but I'm going to show you real results that proves that this works. I will give you guys an exact checklist for what you need to enter and exit every single trade so you take the guesswork out of trading. You don't need crazy amounts of indicators. You don't need 10 years of experience trading. You don't need to even understand multiple time frames. As long as you follow the checklist that we're going to dive into in this video, you can start profiting from this strategy instantly. With that being said, let's go through this step-by-step guide so that you can master this strategy. So this is the checklist. It is a 7-step checklist. If you follow this step-by-step, not missing a single part of this checklist, this strategy will give you absolutely amazing results. So the first step here is to make sure you are on Heikin-Ashi candlesticks. This strategy only works on Heikin-Ashi candlesticks, so you need to make sure your chart is on Heikin-Ashi. Now, how you do that on TradingView is you hit this drop down next to the candle icon and press Heikin-Ashi right here. Now that you're on Heikin-Ashi candlesticks, the next step in the checklist is to add the 100 EMA to your chart. And how you do that is you go to indicators right here, and you're going to want to type in EMA. You're going to see it says moving average exponential. Yours won't have a star next to it. Mine does because I added it to my favorites because I use it a lot. You can do that as well, but just make sure you click that indicator right there, and you'll see it come over here on the top left corner. If you hit this drop down, or if you don't see a drop down, you'll see EMA 9 close. Now we need to adjust these settings. So press this gear icon right here. Under inputs, change the length. Most of the time, the default is 9. Change the length to 100. And that's how you will change it to 100 EMA versus a 9 EMA. We need to have the 100 EMA. The 9 EMA will not work with this strategy. Now, personal preference, you can come over here to style and change the color and the thickness of the line if you want. I personally like my EMA line to be white because my charts are black. The background on my charts are black. So I prefer it to be white. You can make it any color you want. You can change the thickness of the line here. All of that doesn't matter as long as you change the input to 100, leaving everything else the same. That's exactly how you want to have it set up. So just hit OK, and now you have the 100 EMA indicator on your chart. Now, the next step is market structure. So we need to use this market structure above or below the EMA to tell us if we're going to look for buys or sells. So we're only taking buys with this strategy if price is above the EMA. If price is below the EMA, we're not taking any buys. We're only looking for sells. Same thing vice versa. If price is below the EMA, we're only looking for sells. We're not taking any buys because the whole point of this strategy is to be used to trade in the direction of the trend. That's how this strategy has such a high win rate. It's because we're not going against the trend. We're not going against the market. We're flowing with the market, just waiting for the perfect opportunity to hop in. Now, what does market structure above/below the EMA mean? All that means is, let's imagine this is our EMA, right? This is our line. We want to see market structure cross above the EMA. Imagine this yellow path is price candlesticks. We want price to go above our EMA, come down still above our EMA, and continue back up. Once it does that, this created market structure above our EMA. And that's what we want. We wouldn't take a trade as soon as price pulls back and gives us that first market structure above the EMA. We then wait after we had that market structure created for price to pull back again, give us our entry criteria, and we'd hop into the trade and make money to the upside. Now, same thing vice versa. For market structure to the downside, we need to see price break below our EMA and create market structure of a new high below the EMA, simply like this. And once it does that one time, as long as it stays below the EMA, it doesn't matter what it does. As long as it stays below the EMA, we can still look for sales. But if price breaks above our EMA, we then have to wait for a confirmation for price to either pull back and create market structure above our EMA for buys, or pull back below our EMA to then create another market structure for us to then start being able to look for sells once again. But that's all market structure means, and that's what we look for to see what direction we're going to look for trades in. Remember, we're only looking for buys above the EMA, and we're only looking for sells below the EMA. Next, we want to see a clean pullback. This strategy is a pullback strategy. We're taking this strategy based off where the market is going and having small reliefs or small pullbacks, and we're hopping in when price continues in the overall direction. So what does that look like? We all know that price doesn't just go straight up. Price goes up, down a little bit, up, down a little bit, up, down a little bit, right? We are catching price after it goes down a little bit before it makes its next leg to the upside. This is why this strategy is working, because we already know we're going up. That's what we use the 100 EMA to see. We're using the 100 EMA to see what direction the market is going in. We know price is going up. We're just waiting for the small pullback, and then we'll wait for price to go up. Same thing when it goes to sales. We know price doesn't ever just go straight down. Price goes down, up a little bit, down, up a little bit, down. We're waiting for these small pullbacks to the upside. So what I mean by two clean candlesticks of the opposite color, or two clean pullbacks, is with Heikin-Ashi candlesticks, we want to see no wicks on the top if we're looking for buys, up the top of the candlestick if we're looking for buys, or no wicks on the bottom if we're looking for sales. We will see this live when we're going through these trade examples, and you'll see exactly what I'm talking about. Now, the next step is we are waiting for a high volume doji candlestick. That is our entry. So after we had a pullback, like I said, if we're looking for buys, remember, price doesn't just go straight up. Price goes up, down a little bit. If we get a pullback of two clean candlesticks that have no wicks on the top, that's a clean pullback. We're now just waiting for a high volume doji candlestick to tell us that price is going back up. Same thing vice versa with sales. We know price is coming down. It goes up. Our pullback, we need a clean pullback, which for if we're looking for sales, we want to see a clean pullback of at least two green candlesticks that have no wicks on the bottom, or whatever color your bullish candlesticks are. We want to see two candlesticks that have no wicks on the bottom. Then we wait for our high volume doji candlestick to tell us price is going to continue to the downside. Now, what does a high volume doji candlestick mean? What does it look like? High volume realistically means the size of the doji candlestick is either the same size as the last 1 to 3 candlesticks or bigger. I'd prefer for it to be bigger, but if it's around the same size, as long as it's not smaller than the last 1 to 3 candlesticks, that's telling me that it's high volume, because volume is all based off the size of the candlestick, how much price is moving. We want to make sure that we have volume going in the opposite direction. So that's why we want to see a high volume doji candlestick. Now, what is a doji candlestick? A doji candlestick is simply a candlestick that has a small body, a skinny body with long wicks on the top of the bottom. Preferably the wicks or the lines on the top and the bottom of the doji candlestick are basically the same size. They don't have to be exactly the same size, but we want to see at least a similar size wicks on the top and the bottom of the candlestick. We'll see examples of these. I'll show you guys perfect examples of good doji candlesticks and not good doji candlesticks. But just remember, we're looking for a high volume doji candlestick. Now, I'd prefer for that the color of that doji candlestick, because it can be green or red or bullish or bearish color, whatever it is on your chart. It can be whatever color it is, but I prefer it to be in the direction that we want price to go. So if we're looking for buys, I prefer the doji candlestick to be green. If we're looking for sales, I'd prefer the doji candlestick to be red, but it does not always have to. It's just, I prefer it, and the win rate is a little bit higher if you do wait for the color of the doji candlestick to be the same size as or the same color that you want price to go in, the direction that you want price to go in. Now, one thing that we will not do, if we see a clean pullback, we're above the VWAP, or we're above the moving average, and we see a clean pullback, but we got a small doji candlestick after our pullback, we will not take the trade. If we get a large high volume doji after that small doji, we will still not take the trade. We will never enter a reversal after we had a small doji and then our entry candlestick. It has to go from being clean candlesticks to our high volume doji candlestick. It cannot go from clean candlesticks to then a small doji and then our high volume doji. That's not a high probability setup. I do not take those. And you'll see a couple examples of ones that I've skipped later on in this video. Let's say we get a high volume doji candlestick. The next step on our checklist is for our stop loss and our take profit. It's very, very simple when it comes to this stop loss, because we're putting our stop loss right, if we entered for buys, we're putting our stop loss right below the doji candlestick that we entered on. If we just entered in for sales, we're placing the stop loss above the wick, the highest wick of the doji that we entered on. Very, very simple stop loss, not much to think about. This strategy is very systematic. You do not have to have a lot of intuition or any type of experience to know the perfect place to put your stop loss. It's very, very easy. You're putting it above the doji if you enter for sells, or below the doji if you enter for buys. Now, as far as the take profit, again, it is very, very simple. We're always going for a 1-to-1 risk to reward ratio. We're drawing our entry box, our long or short positions, at the wick of the entry candlestick, regardless if we got a better entry. Now, you can hold it for longer than a 1-to-1 risk to reward ratio, but just keep in mind the win rate will drop. If that's something that you're okay with, you can try that, but I'd suggest, and how I trade this strategy is going for that 1-to-1 risk to reward ratio. You do end up getting a better risk to reward ratio majority of the time, drawing your box as if you're going for a 1-to-1. Now, how do we draw our box for a 1-to-1 risk to reward ratio? Like I said, you'll see a bunch of examples of this, but let's say that this is our doji candlestick. We have wicks at the top, we have a small body right here, then we have wicks at the bottom. We'll come over here on our left side panel. If we press this arrow out, we have a long position and a short position. If we're looking for a long position, that means we're going for buys. If we're looking for a short position, that means we're going for sells. In this instance, let's say we're going for buys. Let's press long position. We put our entry right up here. We put our stop loss right below the wick of that candlestick. And we're dragging this box until this risk/reward ratio says 1. Just like that. And that's what we're going for, a 1-to-1 risk to reward ratio. Now, a little trick or something for you guys to understand is with Heikin-Ashi candlesticks, the wick is not where price actually ended. We're entering as soon as this candlestick closes, but a lot of times the candlestick could look like this, but price closed right here. So technically we entered right down here, but we're still drawing our box, like I said, as if we had the entry right here and going for that 1-to-1. So in reality, this is a 1-to-1, but our actual entry, this is actually a 1.4-to-1 risk to reward ratio. Now you'll notice this a lot with this strategy, that you're actually going to be making more than you thought and risking less than you thought, just due to the fact that we're planning for worst case scenario, which is this 1-to-1 as if we entered right at the wick. But in reality, most of the time we have a much better entry. Now, this is the 7-step checklist that if you follow it and you don't skip any of these steps, this 7-step checklist could literally change your life, make you a ridiculous amount of money with this one strategy. With that being said, I highly suggest you guys watch this video back as many times as you need to make sure that this checklist is ingrained inside of your mind, so you don't need to see it. It's automatically in your brain. You know exactly what to look for each and every time to make sure that you're hitting every single one of these checkpoints, giving yourself the highest chance of achieving an insane amount of profitability with this strategy. Now, let's go through a couple of examples so you guys can see exactly how this strategy works, what you should look for, so you can fully understand this strategy and start using it as soon as possible. So the first example we have here, keep in mind, you can trade this strategy on any pair. During this guide where I'm breaking down this exact strategy for you guys, I am trading on a NQ chart. I did an entire back test of the entire month of March to show you guys if you had taken every single trade during this month, what your win rate would have been, what's the minimum amount of money you would have made, as well as what each trade looked like. And we're going to go through a lot of those trades today to make sure that you guys understand the strategy fully, so there's no questions, there's no complication, and you guys are fully clear on the strategy. Now, the only reason I'm doing this on an MNQ chart versus the regular NQ chart that I trade on is simply because my NQ chart has a bunch of drawings on it already, and I did the back testing on the MNQ chart, but these candlesticks are the same exact candlesticks that are on NQ. So you can trade this strategy on NQ, ES, Forex, stocks, crypto. I have a lot of people trading options with it. A lot of my students have been seeing a lot of success trading pairs that I don't even trade. They're seeing success in gold. I don't trade gold. They're seeing a lot of success trading crude oil. I don't trade crude oil. It's working on natural gas as well if you trade natural gas. So I definitely challenge each and every one of you, no matter what pair you trade, to test it out, because every student of mine that has mastered this strategy has been able to make profits no matter what they trade. But let's hop into this first example. As you see, we are below the moving average here. This white line is my moving average. We see we have market structure below it. All market structure means, as I explained to you guys, is we're not looking for price to break below our moving average, give us that pullback, and then we take that entry on the pullback. This pullback, first pullback under the moving average, is giving us our market structure. That's our market structure showing us that we're making price action under the moving average. So once we have that first pullback or consolidation under the moving average, we can then wait for price to go down more, give us a pullback, and we can enter in that pullback. Same thing vice versa if we're looking for buys. We don't enter on the first pullback when it breaks above the moving average. We're waiting for a pullback, price action above the moving average, then another pullback, and on this pullback to the upside, we can actually enter the trade. As you see, we've had multiple pullbacks under this moving average. This is our first one up here. We had another one right here, another one right here, another one up here. We've had multiple pullbacks under this moving average. So now we're just waiting for our entry. Once we have our entry, we had at least 2 clean candlesticks. Remember, we're under the moving average, so we're only looking for sell opportunities. We had at least 2 clean candlesticks. As you see, no wick, no wick, no wick, no wick, no wick, no wick, no wick. We've had more than 2. The key is to have at least 2. We've had more than 2, obviously, which is better. And then we had our doji candlestick. We see our doji has long wick on the top, long wick on the bottom. And as you see, this candlestick is bigger than this candlestick, is bigger than this candlestick, bigger than this candlestick. So this is considered a high volume doji candlestick. We enter as soon as this candlestick closes. When we're drawing out our trade here using our long or short position, if you don't know how to get it on your chart, on the left panel over here, you'll press this arrow. Long positions if we're looking to plan out our buys. Short position is if we're looking to plan out our shorts. So in this instance, we'd press short position. We'd put our entry right at the bottom of that wick. Keep in mind, we're not waiting till price goes to the bottom of this wick, because if you weren't aware, on Heikin-Ashi candlesticks, this candlestick probably closed somewhere up here. It did not close all the way at this wick, but we're entering as soon as price closed. So technically, and this is what happens most of the time, and this is why I explained to you guys that you actually get a much better risk to reward ratio than you originally thought you were going to get, which means that you're risking less than you thought and you're actually making more than you thought. Because let's say when price closed, price was actually up here. We would plan for price to be right here. We drag this until this is at a 1-to-1 risk to reward ratio. Our stop loss is above the doji candlestick that we entered because we're in sales. It'd be under the doji candlestick that we entered if we're in buys. But since we're in sales, it's above it. We're going for a 1-to-1 and we're waiting for price to hit our target. As you see, this is a 1-to-1. But in reality, this candlestick probably ended up closing where price was up here. So technically, our risk to reward ratio was actually a 1.59 to 1 risk to reward ratio. But we are going for the worst case scenario. And that's why I say it's going to be at least a 1-to-1 risk to reward ratio. But 95% of the time, you're getting much more than a 1-to-1 risk to reward ratio, which adds up over time. So this is a perfect example of it. As you see, we entered, our TP got hit right here. We made 66 ticks, which on NQ, that's going to bring you to around $300 of profit within a short amount of time. And that's with one contract. If you use 10 contracts, you would have made $3,000. If you used 5 contracts, you would have made $1,500. If you're on a funded account and we're able to use bigger contract sizes, you could have made a lot more money. That's a perfect example. We have a couple trades that were taken on this day. And this is why I was explaining to you guys that it doesn't matter if you miss one trade, because there are going to be many more opportunities during the day where you can make your money back. Now, this one is a little bit later on inside of the day. I like to take these trades between 8 a.m. Central Standard Time all the way up to 2 p.m. Central Standard Time. But my hot window is really from 9 a.m. all the way to 11 a.m. That's my hot window when I feel like the markets are the cleanest and they have the most volume. But I will take any trade and we'll go through some trades here. The window that I back tested this entire month of March with trading and actual live trades that we've also taken inside my inner circle, they were taken between the hours of 8 a.m. Central Standard Time and 2 p.m. Central Standard Time. There were no trades taken after that. But if you guys do trade outside those sessions, it still does work. You just have to be willing to be trading with longer or less volume, which will take a little bit longer for your trades to hit. But here's another perfect example. We're still below this moving average. We had 3 clean candlestick pullback to the upside. And then we got our doji. Now, keep in mind, I mentioned to you guys, I'd rather the doji be red if looking for sells or whatever color your bearish candlesticks are. I'd rather it be that color, but I'm not afraid of a white candlestick or a green candlestick, no matter what yours is. A bullish candlestick as long as when price closes, it closes below the body of the Heikin-Ashi. This candlestick did close below the body of the Heikin-Ashi, so I would still take this. This is nice high volume doji candlestick. As you see, it's bigger than the 3 candlesticks before it. That's what I like to see. Entered into the trade and TP got hit. This one took a little bit longer, but TP ultimately did get hit. We have another trade that was taken a little bit earlier inside the morning. We got our clean candlestick pullbacks. We got our doji and price dropped down. Now, this is a good example. Price doesn't always give equal size wicks on the doji candlestick. What I don't want to see is a candlestick that looks like this, where it's a huge wick and a super small wick on the top. I prefer all of our dojis to look like this, but there will be exceptions where we do have a doji candlestick that looks like this, that's high volume, but both wicks on the top and the bottom are not completely equal. As you see, this trade ended up hitting. Let's go through some more examples so you guys really understand this. So here are some more examples from a couple days before this. So we're still below the moving average here. We created market structure. As you see, we're below. We made a high right here. Now we were just waiting for a clean pullback to the upside. We got our clean pullback with at least 2 clean candlesticks to the upside. We got our doji candlestick right here entered, and TP was hit within 4 minutes. Again, you see we have another entry here. Now, this is an interesting example. A lot of people will come and ask me, okay, what happens if price touches the moving average and then gives us that doji? I'm perfectly fine taking those. A lot of my students actually consider those their A+ setups because they've noticed that the win rate has been higher. As long as price doesn't go above and close outside of our moving average or makes market structure above or below our moving average, I will still take the trade. So as you see, this bounced right off of it. We got a beautiful high volume doji candlestick right here. Entered into the trade, and this trade hit within 6 minutes, which is a super nice trade. Now let me show you guys some examples from the day before. So we had another trade right here that I did during the back testing. Same thing, price bounced off the moving average, gave us a high volume doji to the downside. This trade hit within 1 minute, within 2 minutes. We can go to the day before. This is a super choppy day. As you see, price was just going up, down. This is why this strategy is